Tobias, I was really excited to have you on today after reading your New Year's Eve call where you actually lowered your target for the S&P before 2019 even started. Talk us through that.
Well, we did it really to line up for the beginning of the year, and Happy New Year to you and to Mike and all your viewers, actually. We did it really, we held it off a couple of days. Obviously, the volatility in late December made it a little bit hard to gauge exactly when to kind of do this, but we figured for the new year we needed to cut the target. It was unlikely that the market would bounce back 25% to our old target of 3,100, although one of the 13 factors that we used to build our targets actually still kept you there. The rest of them didn't. Hence, we pulled it back to 2,850, still 14% up from where we are currently. And it does signal, as you suggested, the panic-euphoria model being one of our key differentiated models, telling us 97% probability that markets will be up a year from now.
So that's the kind of sentiment and positioning piece, Tobias. I guess the question is the trajectory of earnings, right? I mean, the market certainly looks modestly valued if the earnings come in the zone of where the consensus sees it right now. How do you see that playing out?
Okay, so we've been saying earnings will be up about 6% this year. We haven't changed that forecast. The problem really was back in September when that same panic euphoria model was in euphoria territory, telling you markets would go down. One of the big problems was earnings estimates, Mike, up 12% for 2019. And in that context, that number's come down to just under 8%. We still think it's going to edge a little bit lower and get into that 6% range, at which point markets can kind of finish with the reset, if you like, and start to have numbers that they can meet or beat again. I suspect, I don't know for certain, that management teams are going to be a little bit reticent, given some of the uncertainties highlighted around trade that Dom Chu was saying, or around Brexit, or around emerging markets, that they're going to really try to overpromise and underdeliver. I think the reverse is likely. They're going to rather guide down during the earnings season and try to bring down expectations that they can potentially beat or at least meet them.
Does it worry you, Tobias, that most Wall Street strategists expect the S&P 500 to rise this year on a pretty simple view, which is we're not entering recession and stocks have overdone it here?
Well, I think it was more that we were overdone to the upside back in September timeframes, that investors got a little bit too happy, a little too excited, and now they've kind of gone reverse with a 450-point decline in the S&P. If you were thinking recession, for instance, let's go down that path for a moment. That typically, in a normal recession, not the kind of global financial crisis environment of 2008, 2009, but a typical recession, you'd be down 20-25% on earnings, and similarly in the markets. And you've put about half of that behind you already. So from that perspective, we haven't priced in recession, but we've priced in a higher probability of recession. The lack of likelihood of one is pretty significant if you look at a variety of lead indicator models, including just simply the C&I, or Commercial Industrial Lending Standard Survey from the Federal Reserve Board. That typically leads the economy by 9 months, and it showed further easing when it was reported in November. So investors are certainly worried about a variety of factors, and again, that's captured in the sentiment data. It's also captured in the multiple coming in. And Mike, you mentioned the multiple. We do something called the PE bullseye. We look back to 1940, various trailing PE ranges of it's 8 to 10 times, 10 to 12, 14 to 16. We're in that 14 to 16 range right now. That's the second best, if you want to call it, performance indicator, suggesting mid-teen type returns. So the market, unless you really get the recession, the market does seem to be pricing in a lot of now upside opportunity as opposed to 3-4 months ago when it was pricing downside.
So if the bet is no recession, despite the fact that the market has gone some distance to pricing one in, Tobias, where within the market is going to benefit the most? Would it be the cyclical areas?
So I think value stocks and cyclical stocks have been the most, if you like, capitulated upon. In other words, investors have almost totally given up their yesterday's news. In fact, they're in yesterday's trash. And on the other hand, there's, for example, with technology, there's still debate. Is the stocks, something I should be buying on weakness or not? There is no debate when it comes to things like banks or energy and things like that. And that's why you get pops like you got this morning in energy.